respecting that central bank intervention is always a wild card. Under current conditions, the odds favor more downside in stocks in the weeks ahead. In this week's video, we'll show why a bounce could come next week, but we're concerned relative to the market's current technical profile. This is last week's title slide. We said the bulls have a very small margin of error, and we discussed support. We'll update that support in this week's video. We'll open with a look at DeMark counts and wave counts from DeMark for the S&P 500 daily. We'll focus on support and Fibonacci retracements. We'll update our study of the market's current technical profile as of Friday's close using the CCM Models, and we'll look at it relative to high risk periods in 2012 as we've done in past weeks. We'll look at numerous charts, including long versus short, stocks versus bonds, materials, and the credit markets. This is another slide we used in last week's video. 2 points. The market looks vulnerable. We said above 1593, some patience was in order. We closed below 1593 last week, which means now the bulls have to prove something to us. If we get a bounce, we need to see sufficient technical improvement. Otherwise, we would use that bounce as an opportunity to lighten up or maybe even add defensive assets. The wild card always is intervention from central banks. They can change the tone of the market instantly, so we'll have to keep an open mind and watch that news wire and make sure they don't throw us a curveball relative to changing the market's profile on a dime. Just a quick update on our backtesting project relative to our rules-based system. This weekend we've been working on 2009, 2010, which means next week we'll continue to plow through this as the market allows. We might be a little bit quieter on Twitter and on short takes, but you can expect our frequency of posts to pick up in the coming weeks. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily DeMark chart in the upper left-hand corner for the S&P 500 index. DeMark charts and indicators are proprietary tools from Market Studies, LLC. For those of you that know DeMark or have watched our videos in the past, you know that a blue 9 paired with a 13 on a DeMark count can signal potential trend exhaustion. You can see this 13 here, and the day that the market peaked on May 22nd was an excellent signal. However, DeMark has 4 counts. This is the aggressive combo count with the 13. The aggressive sequential count is on a 9 and a deferred 13, which leaves the door open to come back towards this 8 bar in this area here. If we look at the standard combo count, it too on a 9-9 and leaves the door open for the market to rally again. And the standard sequential count also on a 9-9, leaving the door open. So from a count perspective, it's somewhat of a mixed picture. Let's shift gears and look at DeMark's automated wave count. Markets have a tendency to move with their primary trend in 5 waves. So this is a 5-wave move. From a wave count perspective, somewhat of a mixed picture. We either have a counter trend move of an A, B, C that could be completed now, which would say that leaves the door open to a rally and more upside. The alternate count is that we're just now beginning potentially wave 3 down, and wave 3 down would mean that we're starting a new downtrend. So from a count and wave perspective, these DeMark tools leave the door open to more upside. They also leave the door open to more downside, which says we should be flexible in the coming days and weeks. Now we'll provide an update to the market's current technical score. We've looked at this chart several times in videos recently. This is the S&P 500 daily, and this is the year 2012. Point of the exercise, we're looking at the technical profile on May 4th, 2012, just prior to a significant decline in the S&P 500. Similar situation here on October 19th, 2012, a technical profile that was followed by significant and rapid downside. How do these two dates compare to the market's current technical profile as of the close on Friday, June 21st? This is a table we've looked at several times in the past. We'll provide an update here. What we're showing is a composite technical profile and scoring system for all of these charts. If you want to track the S&P 500, the most important chart is price in the S&P 500 itself, and as you move down, the correlations with the S&P 500 become weaker, and thus these charts and the indicators in these charts carry a lower weight relative to these charts. To find a detailed description and to see some of the charts behind these composite scores, you can Google the Shavako Capital channel, find the video with this name, and look at the 549 to 810 segment of that May 25th video, and I'll give you a detailed description of this table. What we're looking at here, these are the two dates where the market was vulnerable in 2012. The composite technical scores of these charts and the indicators associated with these charts was a 33 in October of last year and a 17. That's on a scale of 1 to 100. Those are very weak technical profiles. You can see back in May of this year, we had a strong profile at 82. It dropped down at the end of May to 72. A week ago from Friday, it was at 44. And on Friday the 21st, we dropped all the way down to a 23, which tells us we're in the middle of these two vulnerable profiles. And it says that we should be ready to take additional defensive action over the coming days and weeks. This is the same scoring system here. It just gives us an idea of how the market deteriorated last week. On Tuesday of last week, on June 18th, the composite score was still relatively strong after a rally at 71. Wednesday, we dropped down to a concerning 50, and Thursday and Friday of last week is really when the market broke down. We've been taking money off the table and reducing risk over the last few weeks, and we did so at a faster rate on Thursday and Friday, and a big part of that is the technical deterioration, including price, in the weekly charts. Later in the video, we'll show that it's possible that the market's ready for a bounce. We just saw from the wave count perspective that you can count an A, a B, and a C wave, which also says we might get a bounce. But this is an extremely weak technical profile, and until the market regains its footing, the odds favor lower lows in the weeks ahead. This is the daily chart of the S&P 500 index that we reviewed in detail in last weekend's video. Just want to make the quick point that we said our concerns would increase if the market moved into this red box. And you can see last week we came into the top of the red box trying to bounce here. But what once was support may now act as resistance. So we now have potential resistance at 1593, 1597, this trend line here, the 50-day moving average here, and this blue trend line here. During the week, we often post links to live charts on our Twitter feed, which is at Shavako Capital. You don't need to know anything about Twitter or be on Twitter to use the links. If you go to Google and search for at Shavako Capital or Shavako Capital Twitter, you can come to this page just like any other page and use any of the links on the page that can take you to live charts. This is a noisy looking chart, so bear with me. This is a daily chart of the S&P 500 index as of the close on Friday, June 21st. If we walk through each component of this in isolation, it's not too difficult. One potential area of support is simple moving averages. We have the 50, the 100, and the 200 in blue, red, and green respectively here. Rather than go over these levels, I think it'd be easier for all of us if we just tweeted a live link to this chart a few times next week, and you can see how price is moving within. You can see here on Friday when we made the intraday low that we made that low at the 100-day moving average, which tells us to be open to a bounce next week. Any of these areas, these downward sloping trend lines, which make a trend channel, could act as resistance if we move higher. The 50-day moving average at 1618 could act as resistance. We also have Fibonacci retracements. If you try to retrace this move from this high to this low back in this direction, your levels are 1619, 1632, and 1645. Other potential areas of support would come from these green parallel trend lines. You can see you're drawing a trend line from a high to a low here. We broke through that trend line. This may act as resistance. This could act as support, and this could act as support. The chart also shows Fibonacci levels. The most important ones would be most likely from the November low down here in the lower left-hand corner of your screen. So you're looking at this move from here to here. These dark lines are the retracement levels. They come in at 1475, 1515, and 1555 on the S&P 500 index. This is a similar look. It's a little cleaner. This is from a weekly perspective. We're looking at Fibonacci retracements using this closing low and this closing high. Again, roughly 1549, 1550-ish, 1513, and 1477. We'll also try to tweet a live link to this chart next week as well. This is a monthly chart of the S&P 500 dating back to 1998 here. What we're concerned about, we've looked at this before. The year 2000, this acted as resistance. The same line acted as resistance again in 2007. You can see we got a bullish breakout last month. Purpose of the exercise, what once was resistance may now act as support. We closed basically right on, the T here is on the blue line at 1592. Last week we said if you're a bull, you'd like to see 1581 hold. We went down to 1577 and change last week and then moved higher, closing at 1592. We don't want to be overly bearish here until this line is taken out. This is a relatively strong area of potential support. Conversely, if we break below that, then we want to defer to the weak technicals and err on the defensive side as we did last week and the prior 3 or 4 weeks. This is the same basic chart. We're just looking at a weekly version of it. You can see here on the weekly there's a cluster here above 1550 that could also act as potential support. You can see last week as of the close on Friday, June 21st here in the left-hand corner that we appeared to close right on this blue trend line that we've been talking about on the last 2 charts. Don't want to spend a lot of time on this. You can read this article yourself, but it's good to know about a scenario where interest rates are rising and stocks fall. This article on Seeking Alpha has charts. You can also find it if you go to Google and search 1994 Nightmare and Short Takes, which is our blog. You should get this as the first option, Shavaco Capital. If you click on it, it'll take you to that article which has charts of what happened in 1994 where yields spiked and the stock market fell. So this is a situation where you have stocks and bonds dropping simultaneously, which is what we had last week and the week before. It's another chart that we've looked at in the past. This is the HDGE ETF relative to the S&P 500. So think of this as risk off relative to risk on. This is what risk on looks like for the stock market. And this is what risk off looks like, telling you that the demand for hedging is greater than the demand for being long and owning stocks. Purpose of the exercise: when you get this moving average crossover and price above the two moving averages, it tends to raise concerns about the stock market. Stock's weak. Come up above, trend going this way, stock's weak. This is a pretty bullish look to this chart, and if this is a bullish look here, it's concerning for the stock market. We've got price above blue and red. This also says that relative to the S&P 500, as long as this look holds, shorting might be a better place to be than being long. But we just have to keep in mind, short term, we held at that 100-day moving average, and we also have an A, a B, and a C wave that may have completed, so we'll go into next week with an open mind. This is the weekly chart of the IYM Basic Materials ETF. Has a very, very high correlation to the XLB Materials ETF. Point of the exercise, we've looked at this before. This is IYM, or material stocks in black here, in isolation. When it finds support at this line, the pattern has been that the stock market has also found support. You can see we're basically down to this line again, or very, very close, which says that if materials bounce here, the stock market might bounce as well. We'll close this video with a review of what we call the CCM Big Four. What that is that's 4 charts from this model, and as we review it, you'll see some of the reasons why the technical score on Friday was so weak. This is the first of the CCM Big Four charts. This is just the S&P 500 in isolation. The scoring model that we've looked at on the spreadsheet and in the table looks at all of these indicators, weights them relative to their importance, and builds that composite score. What we want to look at here is price, because price is the most important thing. Point of the exercise: when you have a market where price is above the two moving averages, the blue and the red, that's a bullish scenario. This is what a bearish scenario looks like. You can see as of the close last week, it was the first time that we really, on a closing basis, took on one of those concerning and bearish looks. You can see from this low here, we never had a bearish moving average crossover and price below at the same time. Well, we have that now. That looks similar to this point here and this point here. You can see in both of these instances, here's a bearish look where my cursor is, and you do get a counter trend rally, so we have to be open to that. Here's a bearish look, and the next week was up. What this cross tells us is, as long as it remains in place, the bias looking out the next few weeks is down. It doesn't mean we can't be up on Monday or Tuesday, or even see an up week next week, but as long as the technical profile remains in this state, any bounce should be taken as an opportunity potentially to lighten up on your longs or even establish short positions. There may also be an opportunity to move into more conservative assets on any type of bounce, such as bonds. This is the second chart of the Big Four. This is a ratio we're looking at being long relative to being short. This is what risk on looks like. This is what risk off looks like. This could possibly be the most important risk on, risk off chart now. We have that 1994-like scenario, at least in the short run. Doesn't mean that bonds can't rally in the coming week or in the coming weeks, but the last 2 weeks we've had stocks and bonds looking somewhat like the early stages of a 1994 scenario. Under those conditions, this chart becomes more important than your stock bond charts. Point of the exercise is it also has the concerning bearish look where the stock market corrected in the past. As long as it retains this look, we'll err on the defensive side even during a bounce. If we can get a bounce that sustains a bullish look, then we'll become more open to establishing new long positions. This is chart 3 of the CCM Big Four charts. We're looking at risk on relative to risk off. This is the S&P 500 relative to the aggregate bond market. This is the ratio here when it's rising. That's what risk on looks like. This is the S&P 500. When it rolls over, S&P 500 tends to roll over as well. Same concepts. Point here is we do not yet have a full rollover here. This still has a concerning look with a lower low here. You can see the moving averages haven't crossed yet. They're close. This is 1497 in blue relative to 1495 in red. If this ratio takes on more of a bearish look like this or this, we would expect to see stocks start to accelerate to the downside and bonds to begin outperforming relative to stocks, at least on a relative basis. This is chart 4 of the CCM Big Four. This is JNK, or riskier bonds relative to more conservative TLT. Concepts are similar. This chart has not rolled over either, so if it takes on a look more like this or this, when the stock market accelerated to the downside, our concerns would increase. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.